It's no secret that over the past decade, Warren Buffett hasn't been at the top of his game. In fact, between 2010 and 2020, he basically just matched the market. This isn't terrible performance given that most hedge funds don't even match the market. But for a legendary investor with an average annual return of 20.5%, it's rather disappointing. This has caused many to wonder if Buffett has lost his touch in the new digital world. Despite this lackluster performance over the past decade, Buffett has actually been crushing it in 2022. In fact, Berkshire Hathaway is slightly positive on the year, while the overall market has been getting slaughtered. Currently, Berkshire Hathaway is up 3% on the year, while the S&P 500 is down 16%. This recent move means that Berkshire Hathaway is officially outperforming the market not just on an yearly basis, but since the bottom of the 2008 financial recession, which is when he quote-unquote lost his edge. So here's the top 5 reasons why Buffett has been struggling to beat the market and how he's overcoming these challenges. Likely one of the biggest reasons Buffett has had trouble beating the S&P 500 is due to his focus on value stocks. In recent history, value stocks simply haven't kept up with the growth stocks in terms of returns. Between 2010 and 2020, growth stocks almost outperformed value stocks by a full 100%. But while growth stocks tend to outperform during bull markets, they also get crushed during bear markets. And given that the Nasdaq is currently experiencing a bear market, it's not surprising that many of these high-growth names have gotten destroyed. Since the start of the year, the growth stocks in the S&P 500 have underperformed Berkshire Hathaway by about 25%. Conversely, many value stocks have performed extremely well, such as energy stocks. Since the start of the year, the value stocks in the S&P 500 have outperformed the overall index by nearly 10%. So, in the current market environment, Buffett's value-centric investing philosophy is holding up pretty well. Aside from benefiting from a risk-off market, Buffett has also moved towards embracing a few high-growth tech companies himself. If we take a look at his holdings, we'll see that Apple is by far his biggest position. He currently has $133 billion in Apple, which accounts for nearly 40% of his entire portfolio. Another mega-cap company that Buffett has recently embraced is Amazon. His stake in Amazon isn't nearly as large as his stake in Apple, but it is still a billion-dollar position. Buffett has even ventured into some more early-stage tech companies such as Snowflake, which isn't even profitable yet. Currently, these stocks are actually holding back Buffett given that they're all down by substantial amounts. Apple is down 20%, Amazon is down 34%, and Snowflake is down over 50%. So if Buffett is able to post a positive return with all these tech companies being down so much, imagine what type of returns he'll be posting when these companies recover. In the end, Buffett's willingness to finally embrace tech while also maintaining his value positions has enabled him to enjoy the best of both worlds. Another major issue that Buffett has faced over the past decade is simply putting his money to work. Buffett has been holding significant amounts of cash, which of course produces little to no returns. His cash position has gotten slightly better over the past 2 years, as it has dropped from $128 billion to $106 billion today. But there's still a long way to go. But wait a minute, why is Buffett even having trouble deploying his cash in the first place? Well, at the core, Buffett is still a value investor, and though he has embraced some growth plays, he's not willing to buy when prices are quote, sky high. Now, you might disagree with this statement given the recent sell-off, but on a historical basis, the market is still trading for a rich valuation. For example, the median PE ratio of S&P 500 companies over the past 140 years is 14.89. Today, the PE ratio of the S&P 500 stands at 20.34, which means that the average company is still overvalued by 33%. Similarly, the Buffett indicator, which compares the US stock market with the US GDP, suggests that stocks are currently overvalued by 75%. Now, I'm sure there's going to be comments down below that argue that these models are outdated due to low interest rates, excessive money printing, and the rise of international markets. And while you may be right, we have to acknowledge that Buffett is more of an old-school investor. So I think it's safe to assume that he gives at least some weight to the indicator that was literally named after him. Alright, so the overall market may seem overvalued from Buffett's perspective, but regardless of the market environment, there's always deals on the market, right? Well, there are always deals on the market, but the problem is that these are generally underrated small-cap companies that won't really move the needle for Buffett. For example, let's say he finds an extraordinary small-cap company that's worth $1 billion. Even if Buffett bought this entire company and the company grew 10x within the next 10 years, he would only make $9 billion. Now, that's an insane amount of money, but it would only grow Buffett's overall portfolio by a mere 2.6%. Considering this, investing in small-cap companies is simply not a feasible option for Buffett. He has to stick to companies that are worth tens of billions, if not hundreds of billions, and amongst these companies, it's been extremely difficult to spot a deal. One of the main ways that Buffett has been combating this issue is by constantly growing his existing positions. Last quarter, for example, he bought $600 million worth of Apple stock. But this can only take him so far, and sooner or later, he's going to have to find new companies to invest in. As Buffett's portfolio continues to grow and he concentrates on large-cap companies, one of the biggest hurdles he has to face is unintentionally becoming the market himself. I mean, if you just keep adding large-cap positions, you basically just become the S&P 500 yourself. Buffett currently has 48 positions in basically every industry you can think of, from tech and retail to food and banking. While this may not sound like a big deal, it is, given that Buffett is currently breaking his own advice. One of Buffett's most famous sayings is that diversification is protection against ignorance. It makes little sense if you know what you're doing. Now, I don't think Buffett is diversifying to protect against ignorance. I think he's diversifying in an attempt to deploy as much capital as possible. But this naturally comes along with the unintended consequence of limiting upside potential. Aside from breaking his own diversification rule, Buffett is also actively breaking his 20-slot rule. The rule suggests that an individual's financial success could be improved if they could only make 20 investments throughout their entire life. The idea is that if an individual's investment choices are heavily constrained, they would be highly selective with each investment they make, and hopefully, this selectiveness would improve their chances of making good investments. Given that Buffett is currently holding on to 48 different positions, he's clearly not abiding by this rule. But this isn't to say that Buffett isn't trying his best to limit diversification. Even though Buffett has dozens of positions, his portfolio is still extremely top-heavy. His top 10 positions, for example, account for 85% of his portfolio, and his top 20 positions account for 96% of his portfolio. In other words, all of Buffett's investments past the 20-slot rule only account for 4% of his portfolio. Despite all of his efforts though, it's only natural that the performance of Berkshire Hathaway gets closer and closer to that of the market as they continue to grow and their investments mature. On top of all these external factors weighing down on Berkshire's performance, it should be noted that Buffett has made a few major mistakes himself. For example, in the early 2010s, Buffett wanted to get in on all the tech growth, so he decided to buy a legacy player, which was IBM. In 2011, he announced that he purchased $10.7 billion worth of IBM at $170 per share. While IBM did reach about $200 per share in 2013, it has since been on a decline, and Buffett eventually ended up selling his shares for a loss. While this was no doubt a subpar investment, Buffett also made one of the worst investments of his career within the past decade, which is of course Kraft-Heinz. While Buffett maintains that both Kraft and Heinz are great companies fundamentally, he has admitted that he overpaid for the Kraft portion of the business. Aside from paying a premium for the company, Buffett went on to oversee a merger of the two companies, which hasn't been all that successful. I have a full video on the downfall of Kraft-Heinz if you're interested, but in essence, the company couldn't keep up with the prices of generic brands or the healthiness of up-and-coming brands. So they've been stuck in this weird middle ground that doesn't appeal to either demographic. On top of this, Kraft-Heinz has been involved in an accounting scandal. They've had to write off massive losses, and the CEO left during the peak of their troubles. As you would guess, all of these issues have resulted in Kraft-Heinz stock getting obliterated. They're currently down over 50% from their peak in 2017. Despite this horrendous performance, Buffett has continued to vouch for Kraft-Heinz. But it should also be noted that he has been transparent that he would have sold the stock a long time ago if he was able to easily liquidate his massive position. Fortunately though, it does look like Kraft-Heinz has finally bottomed out, and it's starting to form an upward trend. So hopefully, Kraft-Heinz won't weigh down on Buffett's portfolio moving forward. While everything we've covered so far in the video are valid points, something that we shouldn't overlook is Buffett's age. Buffett is currently 91 years old. This isn't to say that Buffett is too old for this or anything like that, but it does bring up the question, how much does Buffett even care about beating the market anymore? When you're over 90 years old, I suspect that you would care a lot more about living out the last of your days to the best of your ability as opposed to beating some vain metric. Buffett clearly still enjoys investing and talking about stocks. That's why he continues to lead Berkshire and regularly participates in press events. But with that being said, I think Buffett has several more priorities that are higher than beating the market, like philanthropy. Warren Buffett is the biggest philanthropist in the entire world, having donated a massive $42.8 billion. And given that Buffett is looking to donate all of his wealth after he dies, I suspect that his #1 priority is to ensure that all of his wealth ends up in the right hands. This aligns with what he's been recommending as well. After all, Buffett doesn't even recommend that you invest in Berkshire. He recommends that you invest in the S&P 500. Considering this, it's pretty clear that Buffett isn't exactly trying to appeal to investors, meaning that maximizing returns is not his top priority. At this point, it seems like he's just looking to see how far he can take it while having some fun. And it just so happens that he's beating the market once again. Do you guys think that this is just some random fluke, or do you think Buffett will continue to lead the market? Comment that down below. Also, drop a like if you're a fan of Buffett's insane philanthropy. And of course, consider checking out our international channels to watch our videos in other languages. And consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.